Ray Dalio is not only the founder of one of the world's largest hedge funds, Bridgewater Associates, managing over $200 billion, but he's done a series of really educational videos, such as how the economic machine works, explaining global macroeconomic policy and what sort of drives the economic cycle in 30 minutes. In it, he talks about very timeless concepts like inflation, productivity, debt, interest rates. These concepts have been around before you were born. They will happen after you're born, and they impact not only the short-term cycles that you see, but they impact the longer-term cycles. Let's say the long-term debt cycles that might, happen every once 100 to 200 years. And so while Ray Dalio provides this wonderful framework to understand, what's going on a short-term basis, what happens on a long-term basis, a lot of folks are left with the uncertainty of, well, where am I today? Because this has a big impact on how I'm expected to live, how it might impact my life, maybe even where I live. So let's understand, where are we in this economic cycle? And so recently, Ray Dalio wrote this wonderful post called "It Starts with Inflation: How Inflation, Interest Rates, Markets, and Economic Growth Relate to Each Other, and What That Means for What's Ahead." So he takes, let's take a step back. Let's understand where we are in order to size up what's going to happen, in the future. So first, understand unemployment is very, very low, recently upticked from 3.6 to 3.7%, otherwise near a multi-decade low. The economy is running hot, short supply of labor. Then you look at inflation. Inflation is running at multi-decade high. The target rate is around 2%, currently around 8%. So there's still a lot of wiggle room between the 2% target and the 8% that it's currently at. So this makes it very clear, with high inflation and very low unemployment, that it's obvious that inflation is the targeted problem. So the Federal Reserve is, so it's obvious that the central bank should tighten monetary policy. Everything will flow from that. Tell me what the inflation rate will be down the road without the central bank pushing interest rates and money and credit and growth rates around, and I can pretty much tell you what will happen. And this is really important, because when you have these cycles, booms and busts, that's really driven off of monetary policy. And he's effectively saying, you will see continued monetary tightening because unemployment's low and inflation is high. And when you have monetary tightening, that results in higher interest rates, that makes it tougher to do business, and you see higher unemployment. This is generally the part of the cycle that people don't like. This is, when people are like, oh man, like more people are not working, or hey, if inflation's high, that really stinks. That's a cost that everyone sort of has to bear. And so he's saying, well, let's try to figure out where inflation is going to be long term, because that also is going to influence where asset prices are in the future. And so he's saying, yeah, Wall Street's assuming around a 2%, 2.6% rate in the future for inflation, but he thinks, let's say over the next 10 years, it might be closer to 4 to 5%, 4.5 to 5%. So this is what Wall Street's expecting, this dotted green line. And what Ray Dalio is penciling out is 4.5 to 5%, saying, hey, you know what? This is a guesstimate, but this is also a guesstimate that assumes that we don't have any significant shocks. Maybe you have a worsening economic war in Europe or Asia. Maybe you have, some sort of, supply shock with limited oil prices. Maybe someone cuts their oil production, resulting in much higher oil prices. So he's saying this 4.5 to 5%, this assumes you don't have any shock. So it could be even higher. And so he's thinking, this is a guesstimate. This is potentially where it is. And what does that mean for investors? Well, let's take a step back to say, well, in order to understand what it means for investors, you should start with bonds. Because if you're a bondholder, you want to get paid and you want to have a real return, or at least you don't want to lose money relative to inflation. And so what he's looking at is sort of saying, well, if inflation is 4.5 to 5%, then bondholders will probably want, let's say 5%, assuming if inflation's at 5%, they'll want it at minimum 5%, maybe 6%, so that they have a 1% real yield. Now, at this point, you might be saying, well, wait a second, how come Ray Dalio is so much more cautious about inflation than, let's say, Wall Street is? And I think there's a couple of key components there, one of which is deglobalization. This past, this crisis with COVID caused a lot of countries to wake up and say, hey, we want to make sure our production is happening closer to where we want to consume our goods. So for example, if you want to have access to semiconductor chips, you might not want to rely on Taiwan. Maybe you want to move it closer to home or in your own home, or maybe it's critical medical production or defense, the industry stuff where you're sort of saying, hey, we need to make sure these key components we have access to in good and bad times. How do we make sure we get that? Or vaccine manufacturing, drug manufacturing. How do we make sure we have these things no matter what? And so that might mean insourcing or bringing things back into your country or bring it near sourcing. So if you're the US, you might say, hey, can we do this in the US? Can we do this potentially in Mexico or Canada? Those types of questions. So he thinks those two trends are structural trends that sort of offsetting, reversing globalization, deglobalization, and that will result in structurally higher inflation. And so this component is leading to a difference from what Wall Street expects, which is 2.6%. So this 4.5% to 5%, and that gets to bond yields of maybe 5 to 6%, which is arguably a very different world. It's also not that inconceivable to assume we get to that 4.5%, or around 4% bond yields, because currently short-term interest rates are around 2.75%. That's where the Fed funds rate is. So if you're there and they're talking about raising, let's say by 1% or 0.75%. So now you're talking around 3.75 to deal with inflation that's around 8%. It's very possible that you see them get to 4% plus at the beginning of next year. So, okay, so if bonds need to get to, and then you have, that's, keep in mind what the short-term rates are for relatively low risk. So then if you start taking on risks with certain corporate bonds, you're going to have to layer on premium on top of that. So then you start thinking, okay, so what's that mean for stocks? So if this blue box is what bonds are, these two pink lines are inflation, this green dot is sort of what Wall Street expects inflation to be. So this blue bar is bond yields, then this green might be stocks, because with bonds, you have a senior claim where you're effectively saying, as a bondholder, I get the right to get paid first. I could even put in terms that you're not allowed to pay dividends. You're not allowed to repurchase stock until I get repaid. You can have terms like that depending on, the severity of the bond. So you might say, well, if bonds are going to require 5 to 6%, once again, this is based on Ray Dalio's framework. For stocks, you might need 6 to 8%. And this is, once again, this is built off of a much higher inflation than what Wall Street's assuming. So what happens if you have 6 to 8% yields required for stocks? So what's that mean for you? Where does the stock market go? What happens to the economy in that scenario? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. In full disclosure, this is not financial advice. And so the way to think about that 6 to 8% yield and what that means for the economy, what does that mean for the stock market? Well, let's look at the S&P 500. And the S&P 500 historically has grown earnings around 6-7%. And you can see most recently the earnings for the S&P 500 was around $200. That's around that is how much earnings the S&P 500 generated relative to the index of, around 3,800 for the S&P 500. And so what you would think is okay, well, if I have around $200 in earnings, let's take a 6 to 8% yield based on that. Let's assume, now they're not going to do that. Let's assume they pay out, that the companies in the S&P 500 pay out this $200 in earnings, and you get a 6% yield. What's that mean if they pay out 100% and you're getting a 6% yield? What's that mean if you're getting an 8% yield paying out 100%? And what that effectively means is that the S&P 500 would be priced around 2,500 to around 3,300 based on that, assuming earnings today of around $200 for the S&P and a 6 to 8% yield. And so that would result for the S&P 500 in about a 15 to 35% drop. Now, Ray Dalio talks about a roughly 20% drop for, economic, risk assets, but it would depend on the duration of the risk asset, meaning how long are you effectively expected to get paid back in cash? Because there's some of these companies are unprofitable and it may take 10, 15 years before you're actually starting to get your cash back. So that's the reason why I'm penciling out a wider range of, let's say, 35% potential drop, 15 to 35% drop that you can see from the S&P 500 if it were to be priced on a 6 to 8% yield today. So that is really, when you look at that, that means, okay, you could potentially go around the COVID lows. It could certainly be around where it was pre-COVID, and effectively years and years of no gains. If that were to happen today, effectively saying from 2018, 2017 to today, really no growth because you've had this dramatic valuation contraction. Now, others might say, well, wait a second, Daniel, shouldn't we think about this over a multi-year period? And this is another possibility. Investing is very rarely has certainties. You need to have sort of a broad range of framework to understand, okay, what are the different possibilities, and assign different probabilities to those different scenarios. And so what I was saying is, well, if that happened today, you would have a further stock market crash where you could have like a 35% drop based on current earnings. If earnings went lower, then arguably you could see, an even lower, valuation for the S&P. Now, a lot of folks will say, well, shouldn't we think about this, let's say, over a multi-year perspective? Because long term, as you see, the S&P 500 and companies in America, and hopefully companies around the world, increasingly generate earnings, increasingly grow their earnings, especially when you have inflation. So let's assume, now inflation cuts both ways. Inflation, obviously, you can result in higher revenue, but people also want to get paid more, so your profits might get squeezed. Nevertheless, let's assume 7% annual growth for S&P 500 earnings, and that takes you from around $200 to around $285 for S&P 500 earnings 5 years from now. So what's that mean for, let's say, the S&P 500 if you were to assume this happens over 5 years? So this, Ray Dalio's right. Inflation is above average. You have this really relatively strong earnings growth of around 7%. Keep in mind, for some years, it's definitely lower than that. And in that scenario, what you're effectively saying is, yeah, the stock market really doesn't go anywhere for the next 5 years. And so that is really, in my opinion, this is a really helpful framework for investors to consider, because this is effectively Ray Dalio saying, yeah, Wall Street and the world isn't appropriately pricing inflation. When you appropriately price inflation and the fact that the central bank is going to tighten and make the economic picture worse with higher unemployment, millions of people that are now unemployed, and that does sort of raise the chaos element as well, as when you have more people unemployed, you have more chaotic events, you have more strikes, you have more just bad things generally happen when people are at home and they're not making the money they want to have. And also it becomes self-fulfilling or really a vicious cycle aspect, because when you have millions of people that are additional millions of people that are unemployed, those folks are going to get some sort of handout from the government. And so you already have large deficits from the US government, around 5% debt to GDP per year, deficit to GDP each year. U.S. debt to GDP is way higher than 5%, like 130%. And so that's an additional 5% that's going to get tacked on. And so you start getting this really challenging aspect, which is, well, the economy turns lower because the central bank's tightening. And so this is, going to result in deficit spending increasing, because you're going to have the central, you're going to have the U.S. government effectively pay out more unemployment claims. And so I'm not trying to have a pessimistic or gloomy outlook. I'm just trying to say, well, what's reality as it is? Because I want to see it. I want to embrace reality as it is. I don't want to ignore it. So embrace reality as it is. And how do I potentially adapt to it? How do I potentially profit from it? And that's where right now I think it's really important for folks to be cautious, because you go back to, looking at where things are, where you could either say, hey, this goes nowhere for 5 years, or potentially, it drops 35% today, and it has the additional aspects of hurting the economy significantly, because that's a lot of wealth that, impacts people. And we haven't even talked about housing, which is also showing signs of slowdown, because once again, the central bank is tightening, raising interest rates, making it tougher to afford things. So I view this not as, I obviously don't like the prospect of millions more people unemployed. No one wants that. But I think it's important to say, oh, okay, so if you have these different components happening structurally, I'm not really saying, hey, I don't think the S&P 500 is going to be 50% higher over the next 5 years based on these sorts of risks. I think that sort of the downside is skewed lower based on sort of this framework of sort of looking at where we are today. So if you have that sort of framework, how do you want to position yourself? So for me personally, that means one is having a large cash allocation, which I've had for some time. And then another aspect is the positions I own. I want to make sure that I have some sort of valuation backstop where I'm saying, hey, even if the economy really doesn't work out well, I'm confident that this company is providing a good or service that is required regardless. Maybe it's something like inflation. Maybe it's something like insurance, or maybe it's something like a medical product. And so, looking at things like that where it's critical, it's not going away. And then, hey, do I have, the valuation to support it, where I'm saying, hey, even in this arguably tough economic picture that Ray Dalio is penciling out that suggests, hey, we're part of that cycle that's now it's starting to look like it's heading down because you have that monetary tightening. Once again, not trying to be gloomy, just trying to see reality as it is. If you have a different take on this data, I'd absolutely love to hear it. If there's an angle that you feel like I'm missing, definitely want to consider it. Embracing reality as it is. And so I look at this personally very cautious. I am looking for compelling ideas. There will be compelling ideas. There are some ones, like I just called out a company that I think has like 600% potential upside to my subscribers at unrivaledinvesting.com. And so I am looking for these individual, setups. But that's, everyone needs to have their own journey. If you're the investor saying, hey, I'm going to sock away, some dollars every month and put it in, let's say, an index, you have to be mentally prepared for the prospect that you're in a situation where, let's say, over the next 5+ years, potentially, that your money goes nowhere. And that arguably you could have been better off putting it just 100% in cash. I mean, a lot of folks in that scenario might wake up and say, why would I want to do that? Like a lot of folks might wake up and say, like, man, like I've been putting my money, I've had this volatile ride, I didn't get anywhere. And then 5 years from now, they pull it all out and put it in cash. And that would be probably the bad thing to do. And so that's why I'm presenting this as a range of possibilities. Like, you should think about how is this going to impact your journey? Arguably a tougher environment, higher unemployment, elevated inflation relative to what historically people have been accustomed to over a multi-decade period. What's that potentially mean for you and your journey? I personally am very cautious, but I'm trying to be opportunistic because I believe if we were to have, let's say, a 35% drop in the next few months, that could create a scenario, when everyone's now pessimistic. And then they're saying, oh man, how are we going to get out of that? In that scenario, I think there could be, just multi-generational wealth creating opportunities. Like where you're saying, hey, buying this is just so compelling. I'm penciling out 10x upside over the next 10 years because it's so obvious. And that's arguably what I'm personally looking for, but I'm waiting. I want to get the right price for that. So if you enjoyed this video talking about Ray Dalio's, the economic machine, and arguably where are we today, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.